In Parag Khanna's 2019 book, The Future is Asian, the author very clearly articulates his view that Asia is the most powerful force reshaping the world order today, establishing and reorientating an Asia-centric commercial and diplomatic system. He highlights that since the Asian financial crisis in the late 1990s, Asian countries' trade growth with one another advanced at a far faster pace than that of the world economy as a whole, taking just a decade for Asia's internal trade as a share of its total trade to nearly double from 29% in 2009 to 57% in 2016. We have spoken frequently on this series about how, following an extended period of US dominance, which has concentrated portfolios towards a relatively narrow group of overachieving US companies, that investors would be well guided not to ignore other areas of the global economy, equally able to produce strong investment returns. Asia is undoubtedly one such area, and we delve into this with the manager of a specialist investment trust targeting emerging companies from within that region, with Gabriel Sacks, lead manager of the London-listed Aberdeen Asia Focus. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Gabriel Sacks, an investment director on the Global Emerging Markets Equities team at Aberdeen. Gabriel joined Aberdeen in 2008 and is the lead manager of the Aberdeen Asia Focus Investment Trust, ticker AAS, and a member of the Global Emerging Markets Income and Smaller Companies strategies. The investment trust structure, in our view, is a great vehicle for investment in both smaller sized businesses and also for gaining access to some of the more emerging and less mature investment markets around the world. The AAS Trust combines both these areas into one mandate and aims to invest in a high conviction portfolio focusing predominantly on exciting, smaller listed companies in Asia. The listed investment company structure provides a fixed pool of capital, far less impacted by the frequent in and outflows of capital and the requirement to provide underlying liquidity to investors. This allows the appointed manager to focus solely on investing for the long term and maximising returns. The Aberdeen Trust is a £520 million market cap investment trust, which at the time of record trades at a circa 11% discount to the prevailing net asset value. In our interview with Gabriel, we discuss how he and the team go about distilling that vast investment universe into a final concentrated portfolio of smaller opportunities in the region, and delve into some of the topical issues impacting the outlook at the current time. We hope you enjoy the episode, and as always, please do get in contact if you'd like any further information on any of the topics discussed. Hi, Gabriel. Good morning. How are you doing today?
Hi, Gordon. Very well. Thanks for having me on the podcast.
No, thanks so much for sparing some time and joining us. So we've got this standard opening question to these, which I think we've asked everyone on the series so far, and all it aims to do is kind of get a bit of an insight into you and how you go about your work, really. So I wondered if there was an anecdote from a recent research trip you've been on or company meetings you could kind of talk us through, or even just an article or book you've read, anything you could share just to give us a bit of an insight into your day-to-day.
Yeah, great. Look, I think the real privilege of being a fund manager, particularly in emerging markets, is that, if you're curious about the world, the job really gives you the opportunity to understand what's going on in different places. And I think the best way of doing that is really the company meetings that we do, where we get management teams face to face with a sort of first-hand understanding of what's happening, the challenges and opportunities that these companies face. So, we're inundated with information from the sell side brokers. We can spend a lot of time reading books, but actually getting on the road and meeting these companies is the fascinating part of the job. So, yeah, I'm about to go to Asia for a couple of weeks in November, spending some time in Singapore, Indonesia, and Thailand, and really looking forward to that because we get really good access to people both at the company level and involved in government and politics. So it's really fascinating stuff. To give you a few examples of companies we've met actually in London in the past couple of weeks, there was a conference of some Filipino companies coming to town, and we met with the hard discount operator. So they're sort of rolling out an Aldi Lidl model in the Philippines, and this is a very German CEO who's done it before in Colombia and had experience elsewhere. And the company really comes across as having the right attributes for being a leader in that space. And with the Philippines, I think affordability is front in mind for consumers. So there's a real room for that format to take share. And I think at the moment it's less than 2% market share in the whole grocery space in the Philippines. So, just learning about that in 1 hour and being able to interview people like that who are very successful at what they do and are driving change and doing a lot on the ground that is probably irrelevant with as far as the politics is concerned. It's really down to execution of their growth strategy is really fascinating. So I'll stop there, but that was that's sort of what we do on a daily basis that I think keeps us interested. I've been in the same job with Aberdeen for 17 years now, and that's really what makes it tick for me.
Yeah, no, absolutely. Yeah, I concur with that. Gabriel, maybe to set the scene, and obviously we talk about Asia small caps here, and kind of if you were to look at an index there, that could stretch to a pretty vast investable universe. I mean, talking probably several thousands potential holdings there. I wondered, maybe just to set the scene, could I ask you maybe just to summarize the approach you use on the trust? And it might be quite interesting to explain kind of how you go about distilling that potential universe into what is a fairly concentrated kind of final portfolio. Could I ask you maybe just to summarize how you go about things?
Yeah, that's a really good question. We have about 50 to 60 holdings in the portfolio. And as you say, if you just look at the MSCI Asia ex Japan small cap benchmark, which is our closest index, there's about 1,700 companies there. But, that index doesn't really include the local indices and the companies there. So, just in China, there's probably 3,000 plus small caps to invest in. So it is a very big universe. And I think that's what makes it exciting. It's a broad and a region with a lot of depth of companies, lots of growth, and actually poor research. So, it does take a lot of work, but I think we benefit from having a large team that have been doing this for over 30 years, very dedicated and committed to Asia and emerging markets. So in terms of how we go about it, the first starting point, and as I mentioned before, we just try to meet as many companies as we can, and then try and build some institutional knowledge around that, record the meetings so that we can go back to it. And you have 35 people on the ground in Asia doing that on a daily basis. Obviously, there are also screens that we can apply, and those screens have become a bit more sophisticated over time. But what we're really looking for is quality. So that really helps filter out, if you meet a company once or twice and you think it's not great quality, you only need to see it again several years later, probably. And for us, quality, I think is rocket science. I think, a lot of people will talk about investing in quality. It really comes down to companies with good governance, strong management teams, a really good industry position, or something that makes them a leader or potential leader in that market. They have some sort of competitive advantage, be it cost, be it a brand, be it, distribution network, first mover advantage. And then finally, strong balance sheets or good financials is very important. So that's what we look for. And the process itself, we have a big team. So we do company meeting, we write an initiation notes. or the analyst writes the initiation note, and that initiation note gets peer reviewed by other people in the team. So it's a very collaborative process where we're trying to, follow up on the key deal breakers potentially of the investment case. And then once that peer review is done, then that stock comes under coverage and is eligible for investment. So we've got across the all cap space, so not just small cap, we have about 500 stocks under coverage. And then we can pick for our portfolio the companies based on size, quality, or, just I guess the balance we want to fill in the portfolio. So then it becomes more of a portfolio construction decision.
Yeah, no, that's very clear. And I think that sets the scene well. I mean, whenever you kind of go down the market cap spectrum in any market, you start to come into some slightly less household names, and I guess that's particularly so when you move to some other areas of the world like Asia. So I wondered, just to kind of give it a bit more of a sense of what we're actually getting here in this portfolio, whether you could kind of give us some examples of some holdings that really exemplify the approach, whether they kind of exhibit the characteristics that you just talked about. Could I ask you just to give some kind of real life examples?
Yeah, absolutely. And just to kind of go back to the earlier question as well, I forgot to mention, our top 10 holdings are less than 1% of the index and are sort of 30% of our portfolio. So we are very different to the index. And, most of our holdings won't be familiar names for investors or people here in the UK. But I'll give you a few examples. So, there's a lot of negativity around consumption in China at the moment. But one of the areas that we found some interesting ideas in sort of this new consumption theme. So we invested in earlier this year in two companies that have actually done quite well for us. One is so the Spotify equivalent in China. There's actually two businesses that are quite strong in music streaming. One's Tencent and the other is NetEase. To invest in this NetEase cloud music platform, which is very strong with sort of young cohorts of the population, and they're being very gradual in the way that they've been introducing pricing and charging for their services. So most of the user base, 200 plus million people are listening free, but gradually they're adding a paywall and charging for what they do. And the strength of the business is really that it's pretty much a duopoly in that market. It's quite mature from a user base perspective, but it's really about monetization of that user base. And the company has a very strong net cash balance sheet, and that margin expansion as they increase pricing is going to be quite exciting for the financials there. And I think whilst it is a two-player market, so it's not like it's not as dominant as a Spotify, they do have quite clear differences between Tencent and NetEase in the parts of the population that they cater for, in the types of music that they are investing in. So NetEase is doing a lot of in-house brands and in-house studios to develop their own music. So that's one example there of a company that we like in China. And another one in China would be a pet foods company called Yantai, which despite again the demographic issues in China, a lot of more people are actually having pets. So penetration, it's a weird way to describe it, but in the US, 70% of households have pets, whereas in China it's 20%, and people are having more dogs and cats. And there's this rise of local brands, which Yantai is very well placed to do, because they've been manufacturing pet foods for all the multinationals for many years, in the US, in Europe, and now they're taking that expertise to develop a local brand, which is growing very strongly. So that business has been growing sort of 30% revenue per year, again with very strong cash flow from its sort of export business. So it plays into interesting themes, but also very strong businesses with good brands, very healthy cash flow in the sort of small cap space in China.
Gabriel, I'm conscious that you made it very clear in the last kind of answering the first set of questions, just how kind of bottom up the approach is, looking at fundamentals, company meetings being such a big part of things. But I guess I can't not talk about the kind of macro picture a little bit, because it's been a market which has been driven by kind of macro considerations over the last several years, particularly I think, and this year notably so by the US trade policy changes. I wondered if I could ask you to kind of summarize how you're viewing the macro picture in relation to Asia at the moment.
Yeah, look, there's a lot to unpack when it comes to macro. I think it's definitely something that we spend a lot of time thinking about. So I wouldn't say that we completely ignore macro, and particularly when it comes to portfolio construction, I think it's something that we need to think very carefully about so that we don't take a lot of unintended risks, or just, we're too skewed to a particular market or factor or whatever it is. I think, it's interesting looking at the bond markets and what they're telling you. I'm not a bond investor, but, emerging market bonds have done a lot better than developed market bonds in the last 5 years or so since COVID. And it tells you that perhaps the risks are actually rising macro-wise in developed markets rather than Asia and EM. You see French bond yields going crazy at the moment. You see gold going, spiraling as well. I think that's telling you something about, where the risks lie, because there's this perception where that, developed markets are risk-free. I'm not sure that's the case. I think Asia has been very orthodox in the way that they've managed their economies, and we can talk about political issues in some Southeast Asian countries, and the property market excesses in China, but by and large, fiscal excesses are much lower at the moment in Asia. There's no inflation problem. There is monetary easing coming through that's supportive of growth. And I think if you continue to see an upcycle in capital expenditure globally, which you are seeing because of the build out of AI, because of energy transition to more renewables, all that stuff is actually quite good for Asia, where most of the manufacturing base of the world is. So I think the medium to long term outlook is still very strong from a macro point of view, and we're seeing, when you speak to the companies, there's a lot of growth still, and earnings growth has been good. But there's always tail risks that we can't control for, and we don't have a crystal ball. So geopolitics has certainly become more important in the last few years. So that's something to watch. But I don't see tariffs as being as big a negative as a lot of people think. I think tariffs is probably bad for US consumers because it just pushes prices up for everything. It's not good for Asia insofar as it probably will slow down global growth, and that will have indirect repercussions for all countries, really. But yeah, I could go on, but I think those would be my optimistic take on on Asia versus developed markets. And when you come to equities, just finally, when you have 70% of global market cap represented by by US equities, and there is a potential there that people start to question whether they've put too many eggs in one basket. But we'll have to wait and see. The AI story is going bananas as well, with so much spending in that space, and maybe AI will save the US and save the world. But we do think that there's room for diversification in equity markets at the moment.
Yeah, no, some really important points in there. Thank you for that. I mean, you mentioned the kind of US market dominance equity wise, but I mean, even within Asia markets, I mean, one of the features of the last several years now really has been that kind of wide dispersion within Asia, whether it be kind of the swings that we've had in India markets, and then China stimulus kind of seeing a bit of a rebound in China. I mean, how have you navigated that in the portfolio? Again, appreciating that you're very much bottom up, but how have you navigated some of those kind of dispersion in returns that we've seen?
Yeah, look, I think it's a really important point, because it's easy to just bunch all of Asia into one, but there has been very disparate performance between some of the markets, notably, as you say, between India and China. So, over a longer period of time, India has trounced China in equity market terms, but this year that's reversed to an extent. And those are quite big questions. If you get that wrong, it can be a big headwind for performance. And when you look at EM in general, China has been the key drag for the asset class. In the way that we've approached it is, I think, primarily, I think there is a desire to be diversified and balanced in our approach. So just, you know, using a bit of common sense there in terms of, that we have a big region to invest in. Let's try and get businesses that are quite uncorrelated, but still have a great growth outlook and not overexpose ourselves too much. I think we do that from a total return point of view, but we have also been doing it a little bit more from a benchmark point of view and looking at, our relative risks in the portfolio, because at the end of the day, we do want to outperform our benchmark. I would say that how I think about the portfolio at the moment is from a diversification point of view is four buckets. So we've got India, primarily there's one holding in Sri Lanka, but that's about a quarter of the portfolio. Then we've got China and Hong Kong, about just under 20%. Then we've got Southeast Asia as a big piece as well. And finally, Korea and Taiwan, which is a bit more tech and export driven. And those four buckets, they're not equally split. But if we don't veer off too much from that sort of balance of having a bit in all those four buckets, gives us really good access to lots of different themes, lots of different growth, styles as well. So, you have nice yields in some markets and, very fast earnings growth in others. So I think that's played to our favor in the last few years. But, that's not to say that we won't get it wrong at some point. I think we do need to, we have more sophisticated risk tools that we're also trying to be more disciplined and careful about portfolio construction, because it's very easy to say, I love this company, I'll stick it at 10% of my portfolio. But, what's the basis of having that at 10%? How much of it tracking error or your risk is being driven by that single stock or that single factor? And are you comfortable? If you're comfortable, fine. But those are some of the things that we think about from, I think I got into quite a lot of detail there, but just in terms of, how we're thinking about the discrepancy between the different markets.
Yeah, no, really useful. Yeah, thank you. I had a couple of other quick questions maybe on just kind of how the management of the portfolio. And the first one's on the kind of investment trust structure. I mean, obviously this is going into some slightly less mature markets, into small cap. I mean, what are the benefits of running that strategy in an investment trust structure from your perspective?
Yeah, I think the investment trust vehicle is fantastic. I think it's underappreciated at the moment, and it'd be great if I think we're trying our best as a company as well to bring the love back to investment trust. I think for what we do, it's really important because small caps have been out of favor as an asset class for the best part of 10 years now, or more, but actually it's delivered great returns. So the fact that you have this fixed capital vehicle to invest in and offer investors access to this fantastic asset class, which over 20 years has done almost double MSCI World. It has actually performed really well despite being out of favor, although 20 years captures a period where it was in favor. That first thing, that's pretty good. Also, the fact that we're looking slightly lower down the market cap spectrum and liquidity starts to become an issue. We don't have to think about it as as carefully as if we were a mutual fund manager, because we don't have to worry about redemptions and subscriptions to manage. So that's really helpful. And then clearly also you can gear up, which we do. Trust is about 7-8% geared at the moment. So that's come down a bit given strong NAV growth. But, we like the fact that we can gear it a bit because our portfolio is high quality, slightly defensive maybe. So gearing up a little bit does add a kicker to returns and has added about 1% to the NAV over the last annually over the last 5 years or so. So, those are all good things. And, I think there's other things that you can do as well with a trust structure, which gives you more optionality. And I think it protects investors more as well.
Yeah, absolutely. I'd agree with that. Gabriel, I wonder if you talked about kind of management of risk a little bit in an earlier question. I wondered if I could pick up and just kind of ask you to go into a little bit more detail about that. Because I mean, again, it is a kind of small cap orientated portfolio. Kind of how do you kind of go about managing risk, and some of the kind of the processes you put in place to kind of look to get exposure to that theme that you're trying to get, that small cap effect, that rise of Asia consumption, but in a kind of risk controlled way?
Yeah, so the first thing is at the company level, at the stock level, by buying quality companies, we think we are, you know, that's the key way of protecting
Yeah.
or preserving capital. So that's the first thing, uh, if you buy a really crappy company, excuse my language, there's more risk that you lose capital there.
Yeah.
So that's the first thing. And then the second is around perhaps what countries and industries you want exposure to. And you talked about maybe going into sort of racier markets and frontier. I think we don't have a lot of exposure to frontier markets. We've got one holding in Sri Lanka, and the exception is Vietnam, which I'm quite positive on Vietnam. And I think it is quite different to many emerging or frontier markets in the sense that they have a lot of foreign inflows of hard currency and dollars because there's a lot of investment. I think foreign direct investment to GDP in Vietnam for the best part of a decade has been 8% of GDP. So there's a lot of flows of dollars, and they're an exporter, so they make a lot of money in dollars as well. So that reduces one of the key issues with frontier markets, which is around fiscal and current account deficits, which, in the case of a Pakistan, every 2 or 3 years, they need to go get an IMF bailout and the currency blows out. So we try and we've minimized a bit frontier market exposure. I think if you get frontier markets right, the right inflection point, that's great. But we've tried to minimize that a bit in the portfolio unless we have a strong view on both the stock specifics and the macro. And then I think what I referenced earlier was more around the portfolio construction piece, which I think we've, as a house, as Aberdeen, we've over years improved a lot and have more sophisticated risk tools to look at correlation between stocks, look at the factors that we're exposed to, and just be comfortable with it, really. So you don't have to minimize all the risks. You just have to make sure that you know what they are. And if you're comfortable with, so, we have 5% overweight off benchmark to Vietnam, very comfortable with that. We're underweight India because India small caps are quite expensive, comfortable with that. But, having the discussions really focused on why you're taking those risks is important. And then at the stock level, whenever a stock is over 10% of our tracking area, really think about whether it's time to bring that holding down. And typically that's when it's about 5% holding. So, our rule of thumb is about 5% weight in a single stock, but it could go higher if we have very high conviction.
Yeah, no, thank you for that. All interesting to hear you talk through that. And we have managed to save a bit of time here at the end, actually. And we ask a question at the end, which just asks the speaker for some kind of high conviction areas that they have at the moment. I wondered if I could maybe ask you just to highlight some of the other opportunities that are making it into the portfolio or that you see in Asia small caps at the moment.
Yeah, it's like choosing between your children, which is where your favorite one is. It's hard. And invariably, when the one you say is probably not the one that's going to perform in the near term. I think we're putting a bit more capital to work in Southeast Asia. We already have quite decent exposure there. And I think over the last 5-6 years, we've been reducing that. But we're getting to a point where I think the valuation discrepancies are quite wide and there's a lot of negativity. There hasn't been much flows into Southeast Asia. So I remember many years ago, Philippines being a darling of a market because of its demographics. And, it's just so cheap at the moment. There's no foreign investors really looking at the Philippines much. So, we're not going to have too much there. We have about 3.5%. But, there's in each of these Southeast Asian markets, we probably have 3 to 5%. And in aggregate, they add up. But those businesses are looking very good value with, very healthy yields. And then in the case of Vietnam, lots of growth as well. So I'm very positive on the Vietnamese bank we have called MBB, which, I think the government's really removed loan quota. So the banks are starting to lend and you should see good asset growth and also recovery because there was a crackdown on the property market and whatnot. So you're seeing an upcycle in the banking sector and property market in Vietnam, which should be quite helpful. So Southeast Asia, I think is probably the contrarian call at the moment. Last year we saw very good performance in India. This year you saw China come back, Taiwan incredibly strong, and Korea also come back from very cheap levels. So Southeast Asia might be the time for them to for that region to shine. Although I think China can also, our Chinese holdings have done well, but I think there's more for China to deliver if our medium to long-term thesis is right on these stocks, there's a good runway for growth there.
Yeah, no, thank you for that. Gabriel, thanks so much for your time. Really interesting to talk through what is a really fascinating area of investment. I appreciate your time.
Pleasure. Thank you.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.